This is the London Fintech Podcast, bringing you practical insights and approaches, stories and inspiration from the innovators who are building the new world of financial services. This podcast is brought to you by NextWave, strategy specialists and solutions for financial institutions. I'm Tony Clark, and this is the London Fintech Podcast. This show is all about stories of innovations and success from the world of fintech. And on today's episode, I'm delighted to be joined by Dan Awrey. Dan is a professor of law at Cornell Law School. He's also the co-author of Principles of Financial Regulation and a founding managing editor of the Journal of Financial Regulation. Dan more widely has worked for the US and the UK Treasury, the CFTC, ESMA, many other legal, regulatory and industry bodies. And he has a really fascinating insight and position on the intersection of technology, law and financial institutions. So we're here today to hear from Dan all about the book that he has just put together. I say he's just put together. I think it's taken him 6 years to put it together, Beyond Banks. Before we go any further, I'll just say welcome, Dan.
Thank you so much, Tony. It's my pleasure.
Well, it's great to have you here. I've had a bit of a skim through the book. It goes beyond 300 pages and there's a lot to unpack. But just before we get into that, let's get to know you a little bit. So can we start somewhat towards the beginning, early life influences, and how did you end up being a professor of law at Cornell and writing future-facing books about the industry?
Yeah, well, I think my career sort of come full circle at this point. I out of undergrad, I had a nice job at an investment bank lined up right around the time of the Asian financial crisis. The Asian financial crisis basically meant that bank decided to suspend its hiring for a year. I was left without a job and ended up in what we would today call fintech. Ended up working for a company that was making the back and front office systems that were ultimately used to automate the New York Stock Exchange. And then, as you do when making bad decisions in your 20s, ended up in law school, became a practicing lawyer, went to work in investment management for a few years. And an old professor of mine just, I think, sort of casually suggested that I might be interested in doing graduate studies. I'd be interested in going to the University of Oxford, which I did as a career break in many ways, and then never looked back. I joined the faculty the next year and then moved to the US and Cornell in 2019, just in time for the pandemic. But throughout that, finance and technology have been what I do. And so in a very real way, this book is both built on what I've learned over kind of that varied career, but then also really sort of a response to what we're seeing technologically in the payment space and what that means for the financial sector.
So I think you are currently faculty at Cornell, and I think currently also at Oxford, is that right?
No, I have many friends at Oxford, and my co-authors of the textbook and the journal that we run are at Oxford. I have fled to the new world in search of riches.
Yeah. And how do you spread your time? I mean, you working presumably with regulators and corporates alongside the academic part, but how does that look for someone who's a professor at Cornell?
Sure. So I would say that the structured part of my day is what you'd expect in terms of teaching and administrative duties. We have a center for law and financial markets here at Cornell. But then around that is really sort of the work that I do with policymakers. I talk to firms in the industry every day, sharing views and sort of perspectives. I tend not to work directly with a lot of corporates, but I do work directly with a lot of regulators. So currently in the US, the US Treasury Department and CFTC, those being government agencies, you can never really tell when the call is going to come. And most of the time, the deadlines are already in the past by the time you learn that there's an issue or a question that you need to take a look at. So it's pretty frenetic, to be honest. Add to that the book, where it came out in the US in late October. It's coming out in the UK in January. So a lot of additional events and tons of travel associated with that. And then somewhere, that small slice of you that's continuing to do research. I'm working with a lot of data sets on other projects right now that I'm super excited about to move on to the next thing. But at the moment, my current calendar is pretty full.
Yeah, and I think we're quite lucky to catch you today because talking just before the show, you've been in India and you're about to get on a plane to the UK. Where are you speaking from today?
So today I'm in snowy Ithaca, New York.
Okay.
Really the first couple of days I've had at home in about 3 weeks or so. And then, immediately off to the UK tomorrow morning.
Yeah. Okay, well, welcome to London for when it happens. Okay, so let's talk about the book a bit. Beyond Banks, Technology, Regulation, and the future of money. So what was this? What was the genesis of this? What was the what was going around in your head at the point where you decided I need to write this book?
Yeah, the genesis of this book was, on the one hand, my own background in financial market infrastructure, where a series of developments that are pretty soporific, mostly put non-payments people to sleep, had been taking place over the last couple of decades. Some of that was the move to faster payments. Some of that was integrating application programming interfaces into the payment space. But all of it was in the background, I think it's fair to say. And then at the same time, some very high-profile things are happening in the foreground. So you get the rise of non-bank payment platforms like PayPal and Venmo. You get these experiments in places like India and Brazil with entirely new payment systems. We get fintechs entering the payment space. And ultimately, we also get crypto at least trying to experiment on what are today the edges of the payments and monetary system. And so what I wanted to do was bring my perspective as really a financial market infrastructure engineer to bear on all of this new stuff that was happening and how we can accommodate change, both technological and institutional, to move that system forward, but also the risks associated with that system. And that's how I ended up with the book. It was sort of a series of articles where I was dealing with discrete topics within the space, and then wanted to say something a little more broadly about the nature of the challenges and opportunities that I see in the years and decades.
And this is what I really like about the book, actually, is that it's bringing all those strands together. So on this show, if you look back on the back catalogue on what we talk about, there are very narrow fintech innovations. There's AI, there's open banking, there's payment systems, embedded banking, crypto, DeFi, all of these pieces. And I think this is really what you've just called out, that these are the sort of jigsaw pieces of an emerging new framework. So the book is really putting those pieces together and painting a picture of what lies ahead. Is that a fair characterization?
I think it is. It's certainly what I'm trying to do. And it's difficult, certainly. One of the best pieces of advice I ever got about writing in general and writing books in particular is that if you're trying to make people think in new ways, you have to have a really long time horizon for that process. You can't think that you're going to publish one article or six articles in a book and think that overnight the world is going to, first of all, understand what it is you're trying to say, and then to agree with you as that framework sort of develops. And so from my perspective, this is, a big piece of an ongoing project of attempting to reframe the way that people think, and specifically getting them to understand that what's important in policy around making sure that our monetary commitments are stable and credible in terms of regulation, in terms of institutional design, is a different set of issues than ultimately what we're concerned about when it comes to payments and the technology and governance that are sort of important in that realm. And the two have historically worked at cross purposes in many ways, insofar as banks have been at the center of this system. And banks we have engineered to make for very stable monetary claims, but we've neglected the role in payments. And specifically, banks are not technology firms. We shouldn't expect them to innovate in an increasingly technology-driven payment space. But also, policymakers haven't invested in the governance of the payment space such that banks and their regulators are left responsible for a set of issues and policy priorities that historically have not been within their domain. And so that's the rethinking that I'm hoping that to achieve ultimately with this book and other projects, is that there's a lot of juice to squeeze out of rethinking the way that we think about these issues. Good for entrepreneurs, good for customers, but it means a heavy lift for policymakers, at least in the short to medium term.
Yeah, and you've already touched on it. It's a complex ecosystem and landscape. You talked about taking a long time horizon and sort of bringing people with you through laying out the models and the analysis that's in the book. And I think sort of as an overarch, one of the things I took from my research was that you're really also acknowledging a shadow monetary system that is emerging to compete with TradFi, I think, as it might be labeled. The challenge with writing a book about all of this is really to keep it very simple and to tell stories that people resonate with. I think real world examples, so we can sort of take those things that we've heard about, we see in the world, and then place them on that canvas of the new model that you're really articulating. So with that context, perhaps should we unpack it a bit? I mean, sort of where does the thesis of Beyond Banks really start, and then we can go from there.
The thesis really starts with the observation that banks were never going to be the end of monetary history. We've had banks for several centuries, but we often forget that it took those several centuries to really solidify what banking was, to regulate it effectively. And it's really only in the 20th century that we get the legal and institutional engineering that we think of as the financial safety net that protects the monetary liabilities of banks. So you get things like lender of last resort arrangements, deposit guarantee schemes, and resolution frameworks really sort of coming to the fore as policy tools in the 20th century, just in time for a huge technological shock to take place, right? The invention of the internet changes everything in this space. And for a variety of reasons, banks aren't in a particularly good place to take advantage of the internet. Part of the reason was a lot of merger and acquisition activity in the 1990s. Part of it was they're not technology firms, and we shouldn't expect large, complex institutions to be able to adapt new technology or adopt new technology in the same way that smaller, technology-driven, more nimble firms would be able to. What that has meant is two things. One is that all of these new fintech firms have emerged. I often use PayPal as my example because for a US audience, it's relatively ubiquitous at this point. But there's hundreds, if not thousands, of different firms out there who are now providing money and payments outside of the banking sector and therefore outside of the protections of the financial safety net. And so the first big question of the book is then, well, how do we make the monetary liabilities, the IOUs of these firms, as good, as safe for the customers of these fintechs as conventional bank deposits? The second big issue is then we're really seeing the development of a two-track system, one in which incumbent banks continue to be the custodians of domestic and cross-border payment systems, and one in which a new breed of technology-driven firms are using the internet and associated technologies in much more sort of effective ways. And what that's doing is meaning that customers, in turn, are evolving the patterns of the way that they use banks versus non-bank payment platforms. And what's happening, and then the central feature of the book, is that the convenience associated with this new technology is driving customers to use these non-bank payment platforms, even though their monetary IOUs are less credible. And at the same time, banks, as we would expect them to, are often still struggling to compete not on money where they have an advantage, but on payments where they don't. And so you take these two sets of policy challenges, one, the monetary challenge, where the real issue is how do we design laws and institutions that make our monetary commitments credible, with the payments challenge, which is how do we promote the development and adoption of new payment technologies, and how do we deal with the fact that as technology changes over time, we want the entire payment network to be able to evolve along with that technology, but in ways that sort of somehow manage to massage the drivers of competition on the one hand and the need to coordinate standard setting, regulation, and technological adoption on another. So even my 30-second elevator pitch of this book is somewhat complex, but I think ultimately the basic takeaway is that we've got an incredible opportunity to leverage the development of new technologies to make payments faster, cheaper, safer, more convenient at both the domestic and international level. Two, we have a challenge that the monetary claims associated with the firms and platforms that use this technology are currently nowhere near as safe as insured bank deposits.
Yeah, complex indeed. It's shifting. It's definitely a sea change. And my observation would be that the technology enablers, you talked about the internet and associated technologies, have enabled this evolution at a pace that's not immediately apparent on the surface. I remember talking to one of the world's largest banks 5 or 6 years ago in my consulting capacity about the challenger banks, as they were still known, I guess, out of the UK, the likes of Monzo and Starling and Revolut. And the observation was we keep a close eye on that, but we're not too worried at the moment because nobody's switched their salary check across to these new. So they're using them as a sort of savings vehicle on the side, but it's pocket money. It's not where the real payroll goes. My observation, again, I'm sort of slightly uneducated because I don't have the data on this, is that that's changed somewhat, and then now they've got customer numbers in the tens of millions and really building market footprint that's starting to compete. That's been a sort of a slow encroachment, if you like. The institutions still have the enormous balance sheets and the global franchises and the rails for really banking at a different scale. But the challenges have come up on the sidelines, and there's a tipping point on these things. And I think you're seeing that all the way across the financial services sector with insurance and buy now, pay later, and some of the other things we were talking at the top of the show. So it really is, and again, I think you use the phrase in your book, a collision between money's past, present, and future. And we're sort of at that collision point now.
Yeah, I think that's absolutely right. If you look at what PayPal and many other firms are doing, their current advertising campaigns are all focused on getting you to switch where your paycheck goes. That's exactly PayPal's growth strategy for its conventional business at the moment, is to make PayPal as ubiquitous for financial services as your bank is. And, I had the same conversations with senior management at banks 10 years ago as well. One of the things that is an important and sort of implicit story in the book is that you say this has taken place as a slow evolution. I think it's remarkably fast. It took us several hundred years to figure out what banks were and how to regulate them. In 10 years, the split between what banks are doing with APIs and other sort of web-based products and services versus what banks are doing are already leading to a measurable shift in the way that consumers behave. And that's then leading to a change in the business models at the heart of the financial system. That's a decade. That's nothing in financial time. And I think that a lot of these executives are now realizing that their time horizon was just way too short. They were looking a couple of years ahead. And I think in some cases being insufficiently humble about whether people like their banks. Especially after the financial crisis, have no tie to their bank. If somebody gives them something that they want better than their bank does, then technology enables that now, whether it be through open banking or just the fact that a lot of these fintech platforms provide products and services that are simply better than conventional deposit-taking banks. The one thing that they can't compete on, and this isn't good for customers at all at the moment, is the stability of their monetary claims. And in countries like the United States, where we limit direct payment system access to banks, the ability to make payments to the widest possible network of customers. And the reasons for that, some of them are solid, right? Some of it relate to financial stability and the desire to ring fence the institutions that are at the core of that system. But some of them aren't great. Some of them fail to reflect the fact that in many jurisdictions, banks are becoming less important for lending, especially to small businesses, for payments, and for a variety of other financial services. And part of the book is then saying, we may not have 200 years like we did with banks to solve the policy problems that are associated with this shift.
So if you think the recognition and the narrative is shifting with the incumbents from we're not worried about those guys, we'll just buy them if they get big enough, to now we should worry because there's a threat on the business model and we can see things moving very quickly. I mean, can you give us some examples of some of the dialogues perhaps, or some of the practical examples of the things that are resonating at board level with the incumbents now?
I encourage everybody to go back and read. There's a publication in the United States called American Banker, and it's basically an industry rag for what's happening in the banking system at present. It's published every week, and there's a lot of commentary, a lot of perspectives by bankers. And I encourage everybody to go back to 2 points in time. One of them was 1999-2000. Bank technology was really focused on the Y2K problem. It was really focused on mergers and acquisitions and the problems of integrating systems across merged firms. And as a result, it was focused on a set of technical issues that were hard, but fundamentally linked to the fact that in 1999-2000, data lived in mainframes, and those mainframes contained data that effectively could not be shared outside of a closed network unless you stuck them on a floppy disk or some other sort of physical media to share them with somebody else. The first commercial API was created in 2001. At the end of this merger wave, at the end of the hysteria around Y2K, at a point then when these closed networks really, in theory and ultimately in practice, became irrelevant in an instant, right? Once we can move to commercial APIs where I can call and request information from a database from the outside, and if I get the handshake right, I can then retrieve that information remotely across the internet. It sounds kind of dumb and technical, but it's a huge change, and it enables a huge number of financial products and services to be offered across the web. And unfortunately, having dealt with all those Y2K and mergers and acquisitions issues, big bank IT departments were spent. Not only were big banks not in a great position to move towards web-enabled core IT platforms, but they didn't really want to. And that takes me to the second time period, which is 2008, 2009. There, if you go back to American Banker, what you see is a whole bunch of bank executives saying, why would people ever want remote deposit capture? Why would you want to check bills from your computer? Oh, mobile phones, people won't trust those to use financial services. And of course, very quickly, consumers don't care about what bank executives think about whether technologies are valuable to them. And today, mobile banking, being able to not only view your bills, but to manage your expenses from your phone or from your laptop are pretty much key financial products and services. If you can't do that, you can't compete in the 21st century as any sort of bank. And so, I use those examples as a way of understanding both that there's a lot of technological path dependency that hampers conventional deposit-taking banks, but also a lot of what Henry Ford would recognize as wrong thinking about how businesses and consumers view technology and technological change. Henry Ford was famous for saying, if I asked people what they wanted, they would have said faster horses. What we have are exogenous technological shocks that then people naturally want to experiment with to see if they can make stuff better. That is, I think, one of the most natural of human processes. It is one that is at the heart of what entrepreneurs do. It is one at the heart of what customers want, especially in a digital age. And it is one that banks have, quite frankly, a pretty poor track record of acknowledging, let alone responding to.
Yeah, I like the API evolution story there. I remember talking to one of our banking clients, and I'm going to say in 2018, where they found themselves on exactly that position on the back foot, where in the corporate banking space, desire to bank some of the world's biggest corporates, and I can't remember who it was, maybe it was like IKEA or someone they wanted to bank, and they were answering RFPs to provide a banking service. And there was a big section in the RFP, which is, what's your connectivity solution? What's your API? And they were saying, oh, well, we don't have a lot of that. There's not much you can do, if anything. And instantly losing out on to some of the newer offerings. Yeah. and really scrambling to catch up, actually. Do you think the institutions are catching up, or are they falling more behind?
I think in many ways, COVID made banks realize that digital is the present, if they didn't necessarily realize that at this point it was already the past. It's just their present, and I think more so their future. I say this for a couple of reasons. One, we're seeing a lot more core re-engineering, or IT re-engineering with banks than we were previously. We're seeing more migrations to a web-based core, but we're also seeing a lot of banks attempting to create a web-based shell around their their sort of legacy core systems. IT investment associated with those sort of activities is going up. And I think it's in recognition of the fact that a lot of consumers now are asking themselves, do I really want to be with a bank that can't offer me what I, as a millennial, or I, as a somewhat technologically savvy Gen X, sort of in the sort of ascendancy of my career, what I want out of my bank? And so I think they're realizing, or I think they see that the writing is on the wall. I think it's just a question of how they go and implement that. For some firms, it is about core development. You can also see a number of larger global banks who are sort of engaged in killer acquisition activity. So they're buying the fintechs for the purpose then of rolling out that technology on a proprietary basis. And of course, we're seeing a lot of partnerships where banks sit in the background and technology-driven firms, whether it be, examples of Apple Pay and Marcus, the Goldman Sachs bank, or other examples where the technology and the bricks and mortar bank that provide safe deposits and have connections to the banking system, they're not merging, they're not engaged in acquisition activity, but they are partnering with each other in acknowledgement of their comparative advantages, one in safe money, one in convenient payments.
Yeah, I think it is really interesting. I mean, I've got one of the big incumbents coming on this show in a few weeks' time, and I won't give it away. But anyway, they've got thousands of technology innovation patents and are very technology forward. And I think very much feel like that they are technology led across the firm, and you see that across the patch. So there is a modernization and upskilling and a focus on innovation and modern practices, and it's entirely to meet the points that you were laying out here to really protect the franchise and get on the front foot.
Yeah, that's a really good point. Another great way to see how banks are seeing the writing on the wall is to look at the ownership of new patents. My focus in this regard is largely in the United States, where there has been an uptick in banks and patenting activity over the last few years. largely in payment technology, but also sort of back office systems and things like that. And I suspect that other things are going on or have already gone on in other jurisdictions as well.
Yeah, and the user experience for the next generation. So I had a great conversation on this show a few weeks back with Sarah Levy from Betterment, and Betterment are a progressive digital wealth firm. Sarah talks about wealth management for the zillennial generation, which again is a phrase I really quite liked, but it was the digital native and everything on the app and data driven, and it was really all about delivering that real-time service. And they plug in some of the biggest investment management firms in the world in the back end on some of the models and portfolios, but they're providing that front door and that service that's entirely been designed really to fit the lifestyle aspirations and expectations of this next generation of consumer.
Yeah, that's exactly right. And, stories like Betterment, I think, are really illustrative of the opportunities that we're dealing with here, not only at the firm level, but I also think firms like Betterment really benefit from open banking, open finance protocols that have been adopted or being adopted in many jurisdictions. Betterment is never going to aspire, at least in its current business model, to be a bank and provide basic banking services. But it's fantastic for Betterment's customers if they can just take a piece of their paycheck every month and then send it into Betterment as part of their portfolio, and to have that be a seamless process, and to have that process be something that from opening to management of their funds sits in the background and is safe and secure. It's a new type of infrastructure, in effect, that is connecting different types of financial services providers. It means that we're going to get more competition in the space. And hopefully those firms that are in the background, those firms that are providing the old-fashioned financial advice and portfolio building and things like that, they also realize that today's consumers have different expectations. That as the internet, and I almost feel funny saying this, as the internet becomes something that is not new and exciting, but the base layer expectation is that we're all going to have to respond to those consumers. I'm sort of at the age, I won't speak for you, where I'm on the cusp of that, where I'm constantly sort of, on the one hand, one step ahead of my colleagues who are in their 60s or 70s, and I get a lot of street cred for showing them how to use Venmo, versus my colleagues who are in their 20s or 30s, where I look like an old fogey because they're showing me things that they do with and across apps and how they use technology to manage their financial lives that blow me away. And I think that progress, that through line, that direction is something that is transforming financial services and including payments. And I think then the challenge is for policymakers to catch up with that.
Yeah, and in customer service and customer operations, for example, that new generation, they're the folks who actually go out of their way not to talk to someone on the telephone because they'd rather do it on a chatbot and get digital access for customer queries. And so it's a completely new dynamic.
Or people who are very concerned about how their information is used, right? And there's a whole generation now that has grown up in a digital environment where questions around who can use their information or for what purposes are things that they want to take control of personally, right? They want to understand, how this information is being used and by whom and who's profiting from it. And for them, you see products now, sort of the data aggregator Plaid here in the US has the ability to sort of select by provider, by type of information, by use, what it wants to do. And that's all something that, a generation from now is just going to be part of the background about what we do. Some people won't care about it at all, but some people care about it a lot. And technology enables them to take control of that element of their financial lives.
So Dan, we've talked about consumer expectations. We've talked about some of the market dynamics and drivers for evolution of the whole FS space, and that I'm going to say that alignment or tension perhaps between the incumbents and the new entrants. And your analysis has really gone into this in great depth. And I think you've laid out some frameworks and some ideas about the guide rails and the regulation and the governance that should be in place in order to really bring order to the market, perhaps, and some parameters around the new emerging model. Perhaps you could talk about that a bit. So we all get the case for change, but how do you see this coming together?
The first thing to say is that it is my blueprint, I guess, as I call it in the book, is something that is drawn from things that are already happening in other jurisdictions. Maybe not entirely, but pieces of them have already happened in other places, whether it be the UK, Brazil, India, China, Singapore. There's lots of examples where elements of my blueprint are already being put into practice. But the blueprint itself is divided into two sort of pieces, mapping back on to my observation that the legal and institutional challenges of creating good money are different than the technological and governance challenges of creating and fostering good payments. On the good money side, the starting point for my proposal, my blueprint, is really the creation of charters for financial institutions that are not banks that are engaged in money and payments. And sort of my preferred model, and there's a lot of reason to debate whether my preference is socially optimal, but my preferred model is one in which all of the assets, customer assets of these firms that have this new charter are placed in what are known as central bank reserve accounts. These are the monetary liabilities of national central banks. It is the safest form of money in the economy, in the financial system. Once they're there, I've now created a model that effectively removes financial intermediation, taking those customer funds and investing them in the real economy. That's a feature, not a bug, because what it enables then is to remove most of the regulatory structure that we use for banks. These are technology firms. They are not financial institutions, fundamentally. And one of the problems with the PayPals and the Stripes of the world is that if they want to fully integrate money and payments, is that they've often been left with no choice but to get a bank charter and be subject to all the regulation that comes with that, which creates a competitive disadvantage for them. So this new charter would have a much more streamlined set of regulations associated with it, reflecting the fact that they don't engage in financial intermediation. They have far fewer balance sheet risks, in effect.
I mean, there's a variant on that we have in the UK, which is Clearbank, who were on this show also a few weeks back, and they provide the bank rails and the bank accounts for 16 other banks who are really just doing the distribution and the client piece and the customer piece.
UK has been, it's not completely where I would like it to be, but it is certainly farther ahead than the United States in expanding access to payment rails. And really, what I was about to say was that these reserve accounts, also in most jurisdictions, are really the necessary, if not sufficient, ingredient to directly access payment systems. CHAPS in the UK, CHIPS, and other payment systems here in the US all ultimately settle on central bank reserve accounts. And so if you don't access directly to those rails, you have to settle through banks, in effect. And the UK is partway there. I think it's well on its way to reforming that system. The US is nowhere near reforming that system, to be honest. The last ingredient on the money side is then getting money as far away from conventional bankruptcy as possible. In the United States, we exempt banks from bankruptcy for very good reasons, and we replace it with deposit insurance. We replace it also with a resolution framework that then is designed to limit the losses to other creditors, including uninsured depositors in those institutions. And so the last piece is to exempt these new chartered institutions from bankruptcy and replace it with a resolution regime that is designed to do one thing and one thing only, and that's get people their money back as quickly as possible. They're not going to take losses because remember, all of the customer funds are in insured reserve accounts, but they may need to pay their bills quite quickly, and having that money sit in a master account is not going to achieve that. So this would be a very streamlined resolution process, much more straightforward than existing bank resolution processes, designed to achieve that goal of making sure that customers can get their money back as quickly as possible. So that's the money piece.
So the good money piece is central deposits, assurances, resolution, simple resolution frameworks. It's a reframing of the money side of it. Okay.
All under the umbrella of a new charter that gives these firms access to central bank reserve accounts, but then also subjects them to this regulatory framework.
Yeah. And how much have you we'll get on to the good payment side of it, but how much have you market tested this and what sort of response do you get from the industry?
So it depends on where and when we are, basically. I would say in the United States, 10 years ago, the firms that I would envision would get one of these new charters were pretty skeptical. Many have since come around. Those firms in the United States are currently subject to state money transmission laws in 49 or 50 states. One of the papers that sort of preceded the book was me charting exactly how different these state laws were, exactly how poorly they protected the consumers from potential bankruptcy risks. And I think over time, they've realized that having one regulatory framework that actually enabled them to protect customer funds and market their products and services on the basis of that protection was something that was probably a good idea. And so I think in the US, they've come around quite significantly over the last decade to the point where a lot of firms who I would have say were pretty openly sort of skeptical of my early versions of this proposal have now come around to ask, well, what can we do to help make this law in effect? And so that's encouraging. I would say in other countries, at least part of what I just said sounds like it's old hat. Certainly the European Union, and as a result, the United Kingdom, when it was in it, we get the first and second payment services directives, almost 20 years ago now. We get the e-money directive, which in combination do a lot of what I'm talking about. I still say that there needs to be both more readily available access to central bank reserve accounts. And I'm not completely convinced, and nor would sort of market experience suggest that these firms are free from the risks of bankruptcy and that their customers are protected in the event of bankruptcy. But there is a chartering framework in place and a more bespoke regulatory framework on which sort of the other elements of the proposal could be built. We can say the same about Japan, about Singapore, about Brazil, India. A lot of the other jurisdictions that I look at in the book, at least on the good money side of things, have made more progress than the United States has.
Yeah, and I think you're calling out a really interesting point there, which is the US federal structure. So you're talking about centralization, and then as you just said, I hadn't immediately thought of it, but 50 different versions of regulations and rules. So the opportunity to normalize is enormous in the US.
Yeah, and kind of recognizing this, the Conference of State Banking Supervisors in the US has undertaken a lot of work over the last few years, coming up with a model law, attempting to get that law implemented across states. And I don't want to minimize how hard that is to do. Changing state laws is like herding cats, especially when you're trying to change 50 state laws. But ultimately, even despite that effort, they've only managed to change the laws in 22 states, so less than half. And even then, the changes don't alleviate the problems associated with things like bankruptcy, where the federal division of power in the United States is that the federal government has power to enact and amend bankruptcy law, exclude firms from bankruptcy law. The states do not. And so there are some problems where I think states have made progress, but there are other problems where it's just out of the jurisdiction of individual states to actually solve the particular problems that I'm interested in solving.
So the blueprint really presents that sort of single normalized view of the future, but progress to varying degrees in varying institutions and varying states towards that is really what I'm taking from that. That's the good money part. And yeah. So you mentioned good payments. Is that the other part of the model?
It is the other part of the model. And the two are linked. And I won't lie to you. The second part of the model is the more complicated part because some of those 300 pages is dedicated to then explaining how the plumbing of the payment system works for the purposes of then understanding how a judiciously used wrench here and there could actually greatly increase outcomes for consumers, for firms, and for the stability of the financial system. So the first bit of good payments actually takes us back to good money, which is access to central bank reserve accounts. The ability to have access to financial market infrastructure for non-bank technology-driven firms is key. It's key because it enables them to compete on equal terms with banks. The alternative is that they have to use banks to access financial market infrastructure, in which case that's like giving your competitors, your principal competitors, the ability to cut you off from a vital part of your products and services, the financial market infrastructure itself, at any time, for any reason. The competitive dynamics there are horrible. And so the first piece of good payments are what I think of as open access interoperability rules that then give non-discriminatory access to financial market infrastructure, master accounts, clearing and settlement systems in particular, to these non-bank firms. Basically, network access is table stakes in money and payments. And at the moment, law discriminates against who is putting up those stakes. Certainly in the United States, current law enables only banks, and even then not all banks, to connect to the payment system. Other jurisdictions, the UK included, have expanded that somewhat. But really, if you want to unleash the benefits of new technology, you've got to unleash the benefits of competition. And to do so, you have to have a playing field that everybody can play on, and may the best team win. The next element of this is then really what happens with technological change. There's always a dynamic between competition and coordination in any network design, right? Everybody wants to compete to create a bigger product, a better product, especially where they are at the cutting edge of technology. But at the same time, networks rely on people coming up with common standards, common data standards, common technological standards, common operational and procedural standards in order to create an actual network. In the crypto space, we think of this as the distinction between a permissioned ledger and an unpermissioned ledger. The permissions are the standards, in effect, in a very real way. And the current financial system is entirely permissioned. But the question becomes, what if, as technology changes, and as we see today in the marketplace, there are some actors, incumbents, who aren't particularly interested in adopting new technology that might have social benefits. And we have some actors, some new actors, who are only interested in using that technology for the same purposes. How, if they share a network, do we determine the direction and trajectory of investments in that innovation? And that takes me to then the other element of the good payments model, which is a more conscious effort to cultivate governance arrangements with both the public and private sector to answer those type of questions, and to do so within a framework that makes it explicit that those questions should be answered with reference to the public good with reference to stability, the public good with reference to competition, and ultimately the public good in terms of the quality of the products and services that they receive. Today, while that seems pretty straightforward, that's not how we do it today. Primarily, both the US and the UK, for example, give sort of jurisdiction for answering these questions primarily to A, the central bank, and B, incumbent banks. So the central bank is, as it should be, concerned first and foremost with monetary stability. At best, improving payment systems for consumers is a subsidiary objective. In the case of the United States, it doesn't really exist as an objective at all. Second, giving this to incumbent banks has a very predictable impact on the direction and trajectory of technological adoption. If they're the only game in town, their incentives to actually adopt new technology that might benefit consumers but incur costs in doing so are very muted. And we've seen this in the United States in particular over the course of the last several decades, where the Federal Reserve, for all it's done to promote the stability of the banking and payment system, has really not done very much at all to either force incumbents to build new infrastructure or to ultimately build that new infrastructure itself.
This is the London Fintech Podcast, bringing you practical insights and approaches, stories and inspiration from the innovators who are building the new world of financial services. This podcast is brought to you by NextWave, strategy specialists and solutions for financial institutions. I'm not surprised that you described the payments side of this as being more complicated because, and in simple terms, my understanding, you have issuers, you have networks, you have acquirers, and there's such a plethora of different firms, and we touched on a bit of it. Some of it's embedded banking, buy now, pay later, some of it's crypto and DeFi, and there are actually central bank digital currency proxies that have got accounts at central banks and are settling on chain. There's one called Finality that operates across Europe that is doing that, and then there are firms that sit in the payments infrastructure that sit behind other firms. And we had a situation recently, actually, with one of our consulting clients, one of the major banks that very pleasingly offered an early payment opportunity to us. And they offered two opportunities at the same time. And one was a discounted early payment on their own rails, and the other one was a virtual credit card that could have come via any credit card acquiring mechanism that we choose in the market. And it wasn't until you unpacked them that you ended up comparing the fees. And it was a couple of percentage points over here, and it was 1.5% points over there. And obviously that guided us as to which route to follow. But that was just a sort of micro example of this very complicated choice in different channels.
I think this is a really key point. The world has just gotten a lot more complex in this realm. And one of the biggest sort of between the ears challenges that I encounter with policymakers is that for many, the response to that organic complexity is just stop it. Just make it go away. Push everything back into the system that I know. And of course, that comes with costs. And really part of the book is then understanding you can shove the genie back into the bottle if you want to, but you're going to do so at the expense of all sorts of regulatory objectives that policymakers are and should be concerned with. If we're worried about systemic risk and too big to fail financial institutions, is there anything more too big to fail than you are the only payment rails? Of course. If you go back to the financial crisis, policymakers were making statements every day about, well, the reason we needed to bail out banks was because we couldn't contemplate what would happen to the world if the payment system stopped. So this complexity actually has a benefit to it if we can channel it, in terms of making for more diverse channels of money and payments, undoing the too big to fail problem, the competitive distortions, the financial stability implications that flow from it. At the same time, you're also killing competition. You're killing any sort of momentum in adopting new technology that might benefit the public good.
Yeah.
And this is to say that all technology or all innovation is going to benefit the public good. That's the point of the governance framework, is to make sure that we're moving ahead with what's socially valuable and rejecting what's not. But at the same time, if you leave it up to banks, they're going to do what's in their best interests. And I don't fault them for it. If I was running a bank, I would no doubt do the same thing. But I would understand that, especially in countries like the UK or Canada or Australia, with a fairly small number of very large banks is that they're going to slow walk all innovation. They're going to retain the rents associated with any sort of market power that they possess over the payment rails, and customers are going to lose out. When you look at the places that pay the most for payments in 2024, it's rather counterintuitive. It is mostly developed G20, G8 countries that really pay a lot for especially electronic payments relative to some of the more forward-thinking emerging markets. China, India, and Brazil immediately come to mind, where the cost of payments on a unit basis are much smaller than they are in some of these more developed countries.
So Dan, without stealing your thunder, and I'd urge the audience, please go and buy the book, because then you'll really get the benefit of all of the analysis and insight that sits here. But if you get to page 214, you've got a blueprint for reform, and you've been talking about the moving parts and the cornerstones of that blueprint over the last few minutes. But as a takeaway, if you run a big bank, what are the three things that you would urge a big bank to be doing now to get on the front foot for this future model?
Yeah, well, the first thing I would do is pay attention to what my consumers want, not as evidenced by the products and services that I provide them, I, the bank, provide them, but by the products and services they're currently getting from other firms, fintechs, in effect. And take those observations seriously, because what I think we're seeing is how a technological shift in the basic technology that we use, the internet, has over the course of the last couple of decades fundamentally changed the basic set of products and services that financial consumers want and how they want them. So that's the first thing I would do. The second thing I would do is take a look at my own information systems and say, to what extent does my IT core actually enable me to provide those products and services? And if they can't, what do I need to do? Whether that be some sort of wrapper on my existing core or eventually some sort of migration to a web-based core. The third thing I would do is hang on tight, because I think that, and this goes back to my earlier comments about American Banker, is that a lot of big banks historically have not really had to face vigorous competition from non-banks across various product lines. And I don't think payments are the only place where this happens. In mortgages, small business loans, all sorts of different products and services are being provided more and more by non-banks. And so I think they need to change their mindsets, that ultimately consumers want different things. Technology enables you to do those things if you're willing to invest in it. But then understand that the financial system of the future is going to differ from the financial system of the past because of, and especially if sort of my blueprint were ever to be adopted, because of the increased competition that we're going to face in this space.
Yeah, I love that. So really listen to the consumer expectation now and the future. Design your strategy to leverage and upgrade your core capabilities to meet that, but do the whole thing in the context of the future money system, essentially, which is an evolving landscape.
Can I add one thing? Is that I have the same three observations for policymakers as well.
That's my next question, was what were the three things you would say to policymakers?
So the first one is exactly the same. Stop pretending that you have an understanding on the basis of past behavior about what consumers want and are doing now. This is the biggest problem that I face, is that especially a certain generation of policymakers who don't use fintech, who don't face the same sort of financial constraints that a lot of younger consumers are today, tend to dismiss all of this as something that's not actually happening. And this is exacerbated by central bank sort of and regulatory data frameworks that often are not looking at these specific behaviors at the moment. So the first thing I would say is pay attention to what consumers are doing, because their behaviors are changing, and you need to understand why, because the policy goals that you've been set may require a different set of tools and certainly a different set of thinking. Two, also the same recommendation. You've got to figure out how you as an institution, as a regulator or a central bank, need to update and invest in your technological frameworks in order to understand what consumers are doing, what the firms that are catering to these consumers are doing, and what sort of risks exist in this new system. You know, it was hard enough doing data mapping where every node in your network was a bank. Data mapping is much harder now. And there are all sorts of different things, all sorts of different initiatives that have sort of been left to rot over the last decade that I think really need to be supercharged. So legal entity identifiers, legal product identifiers, updating information systems to understand in real time what the balance sheets of these institutions look like. It's not sexy. Your political overlords will probably be like, why are you spending money instead of, prosecuting financial crime or doing other big ticket items that can get you in the press and make people feel good about themselves and their elected officials? but it is the necessary thing to be able to do that in the digital age. And then the last thing, again, is the same. But here it's get ready for the competition and understand that that's going to make the delivery of your policy objectives that much harder. Competition is going to help you in things like consumer welfare, where, especially if channeled through things like the governance framework I've proposed, you will get better consumer outcomes. But competition is also a dangerous thing when it comes to things like microprudential stability and macroprudential risk, where there are trade-offs there. And those trade-offs are going to require you to collect all of that data to understand consumer behavior in order to use your new set of policy tools to stay ahead of those risks. It's going to be a more difficult world. It's going to be a harder world, but it's not made any easier by ignoring all of these trends and all of these problems, which in at least some cases is what policymakers are doing.
Wow. So, okay, so it's to sort of get your head out of the sand. But I think it's very astute, the mirroring of the recommendations you have there for the policymakers and the regulators versus the institutions. And you see this if you look across, the regulators pushing so hard on quantitative controls and data-driven decision-making and showing audit trail for decisions and, being able to rebuild trade stories and these all take reams of data. And to sort of submit that data to the regulators, they've got to have the same infrastructure and the ability to actually process it on their side. Otherwise, there's almost no basis to challenge and measure what the institutional side of the industry are doing.
I mean, and some regulators are doing this, and it's kind of ironic, right? What's the solution to that? An API.
Yes.
Right? Some sort of partner API is exactly what is needed for the purpose then of making sure that all of these data-driven decisions are made with the best possible data. And that takes initial investment. But then if you think about what the savings from that would be over the medium to long term, when we look now, certain jurisdictions come to mind. I won't shame any particular one, where on the regulated institution side, there are whole masses of people who are responsible for compiling individual reports on a quarterly basis or whatever. The call reports sort of go into the key supervisory frameworks. And on the other hand, there are supervisory personnel that are sort of manually reviewing these call reports and then trying to select from them data that they think might be useful for their management teams and senior leadership. An API enables you to build whole systems on top of that. It enables you to integrate things like AI into your decision-making. It enables you to automate a lot of this in ways that lower the regulatory burden while simultaneously increasing regulatory effectiveness. There are all sorts of opportunities here to make this system better. And at some point in time, it just becomes awkward, if not embarrassing, that we're not moving forward very quickly with some of these opportunities.
Yeah. Okay. So, for the audience, so who should read the book, Dan, and where do they get it?
So I think, first of all, my mom should read the book. So postal strike in Canada, that's not going to happen anytime soon. I think the book was really intended for an audience of policymakers. So if you're at all in the regulatory community, I think this book is designed to give you an outsider's perspective on how far the system has gone off track. I think it's there for students of finance because as much as anything else, it's a history of experimentation to how we ended up with banks. And it's a history of experimentation that we're in the middle of about how to deal with a world where technology has given rise to a sort of diverse collection of non-banks. So for students of financial history, for students of finance, for students of technology, I think it would be a very interesting read. And honestly, I think it's some of the best reactions I've had are from practitioners. And again, I won't name names, but ironically, some C-suite level executives from major banks have reached out to me just to thank me for the book. Certainly at fintechs, which I think broadly see this book as a bit of a championing sort of their worldview in some respects. I think it's designed to provide a set of arguments and data about the opportunities that exist in this space for both fintechs, but also incumbent banks. And then lastly, I would say journalists. If there are journalists out there who have ever dealt with me, they probably already know that one of my great frustrations is that I live in a complex world and they live in a world where that complexity has to be distilled down to 800 words. And that's a very different job. But ultimately, I think these sort of books that are designed to expose that complexity and deal with it full on are things that can improve the quality of financial journalism. And since financial journalism is such an important gateway for so many people to understand basic policy issues, I'd encourage them to read it as well.
Yeah, so I can see, you're reaching the executive of major firms and reaching the researchers and the journalists. This is a window really to move the industry forward. So any of you in those audience categories, in fact, anyone else, I think you can get the book on Amazon and probably all your usual booksellers.
I was going to say, yes, I didn't answer the last part of the question. So in the UK, you can get it as of, I think, January 24th on Amazon, at Blackwell's and independent booksellers.
Yeah. And by the way, if you are a C-suite at a major bank who are listening to this and you have a view on Dan's blueprint or want to talk about it, get in touch, come on the show, let's talk about it. I've actually got C-suite from one of the major banks on this show in a few weeks' time, and it would be great to get a few more perspectives from the top of the house. So just to put that out there. And Dan, when you stop now writing your own book, I'm sure you haven't stopped writing, but you stopped writing this one. When you're not writing your own book or reviewing the final draft, which also you're too late for that as well because you've published, what else are you reading? What are you listening to? What's on your iPod?
Yeah, so I tend to read to escape my work a little bit, but I don't really fall that far from the tree, and I tend to focus on nonfiction. So great books that I've read this year include the 25th anniversary edition of Making the Atomic Bomb, which is a technical history of the physics that went into the bomb, but also a tale about poor governance, that the excitement about the fact that we can do something met the realities of what the impact of doing it meant to the world. And it's the story of the people who basically warned, including Niels Bohr and others, that if we're going to do this, if we're going to harness this technology, we also need to create a governance framework that means that we don't harm mankind in doing so. So fantastic book. I highly recommend that to absolutely everybody. Books closer to home that I've read recently, Scanners in the Dark, which is a book about cryptocurrency enforcement out of, in particular, the IRS and Drug Enforcement Agency, and a number of books, a big economic history fan, I guess. A number of books this year have come out about really the logistical challenges of World War II, and not just the fighting men and women, but the people trying to make sure that the men, material, and machinery made its way to the right places at the right time. So either that makes me a very, very boring reader, or I just like to stick to my knitting close to home about highly technical subjects where I get to marvel in other complex issues outside my own sphere of expertise.
I think it's a fascinating set of topics. This episode is unlikely to air before Christmas, so you can't put it on your Christmas list for this year, but maybe some reading for 2025. Thank you for that, Dan. And thank you for taking the time to really explain this vision of the future and to proffer your thoughts and insights on the direction of the industry and some of the things that those in the sector should be thinking about. And for the audience, really hope you enjoy this one. Let us know what you think. And Dan, thanks again.
Thank you. It's my pleasure. I love the podcast, and it's been fantastic to be a part of it.
Thank you.